Please like, share, and subscribe. Wishing you happiness and good luck every day.
All right, let's talk about Warren Buffett. For decades, everyone's tried to crack his code. Well, today, we're going to do just that. We're breaking down his entire playbook into a simple guide you can actually use. Let's dive in. So, you probably think you need some kind of super genius, billion-dollar brain to invest like Warren Buffett, right? I mean, it makes sense. But what if I told you that's completely backwards? What if the opposite is true? Yeah, you heard me right. The surprising truth is that it's actually easier for you to invest than it is for him. See, as a regular person, you've got these incredible advantages that a guy managing hundreds of billions of dollars, well, he just doesn't have anymore. And figuring out that edge, that's the key to the whole thing. Okay, so here's how we're going to break it down. We'll start with your edge over Buffett. Then we'll get into spotting a great business, running a quick financial health check, paying the right price, and finally, the big one, when to be greedy. Simple as that. All right, section 1, your edge over Buffett. I know it sounds crazy, but your biggest advantage is that you're not managing a giant fund. Let's look at why size isn't always a good thing. So just look at this comparison. It really lays it all out. When Warren Buffett wants to invest, he has to move billions of dollars. That's like trying to turn a giant battleship. It's slow, it's cumbersome, and just him starting to buy a stock can actually move the entire market. He's stuck with only the biggest companies. But you're a speedboat. You can zip around, invest a few $100, a few thousand, whatever. You can buy into small, exciting companies and get in or out in a split second. Nobody even knows you're there. That nimbleness is your superpower. And you know, all of this, his entire philosophy, it boils down to this one simple sentence. He famously said he doesn't try to jump over 7-foot bars. He looks for 1-foot bars he can step over. Well, this quote right here, this is the 1-foot bar. Buy shares in a few high-quality, well-run businesses at a fair price and then hold them forever. Our entire job is just to unpack what he means by high quality and fair price. So let's tackle that first part. Section 2, spotting a great business. This is where we learn to separate the real gems, the castles, from the businesses that are just, well, commodities. Buffett basically sees two kinds of businesses in the world. On one side, you've got commodity businesses. Think about staples. Yeah, the little metal things in your stapler. Do you have any clue what brand they are? Of course not. You just buy whatever's cheapest. It's a race to the bottom on price with zero customer loyalty. But then you have a moat business, like Coca-Cola. When you want a Coke, are you really going to buy some generic store brand to save 15 cents? No way. You buy the Coke. That brand power, that loyalty, that's everything. And that brings us to his most famous idea, the economic moat. It's a really simple but powerful metaphor. A great business is like a castle, and that castle needs a wide, deep moat around it to protect it from invaders, from competitors. That moat could be a powerful brand, a special patent, or just massive scale. Our job as investors is to find the castles with the biggest, scariest, most alligator-filled moats we can. Okay, so how do we spot these castles? Well, here's a quick checklist to run through. First, is it a simple business? Can you actually explain what it does in a sentence or two? Does it have a brand that everyone recognizes? Is it a timeless product? You know, like are people still going to be drinking Coke or chewing Wrigley's gum in 20 years? Probably. Do people have to buy it again and again? And here's a big one. Does it have pricing power? Meaning, can it raise its prices a little bit each year without customers running for the hills? If you're nodding yes to these, you might have found something special. All right, so we've found a business that looks like a castle. It passes the eye test, but now it's time to pop the hood and check the engine. Section 3 is our financial health check. We're going to use a few simple numbers to make sure this thing is the real deal. You don't need to be an accountant to see what's going on here. Just look at the earnings per share. Coca-Cola. On the left, it's like a beautiful, steady staircase climbing up. Predictable, reliable. It's a money machine. Now look at Ford on the right. It's a total roller coaster. Up one year, crashing the next. That's the difference right there. A great business with a moat just churns out consistent, growing profits. A commodity business gets absolutely wrecked every time there's a recession. So to make it really simple, here's a 3-step test. First, we look for high profitability. The metric is called return on equity, or ROE. All it tells you is how good the company is at turning shareholders' money into profits. You want to see that number consistently above 20%. Step 2, we check how smart they are with all their capital, not just shareholders' money. We use something called return on total capital, or ROTC. This makes sure they're not just juicing their returns with a ton of debt. Look for something above 15%. And finally, step 3, we look at that debt directly. Here's the question. Could the company pay off all its long-term debts with the profits it makes in under 4 years? For a truly great business, that's usually an easy yes. Okay, so we found a castle, we've checked under the hood, and the engine is purring. We're almost there. Now for section 4, paying the right price. Because let me tell you, even the greatest company on earth can be a terrible investment if you pay too much for it. Let's make this super simple. Forget stocks for a second. Imagine I'm selling you a magic box, and this box spits out $1,000 in cash every single year, forever. Now, how much would you pay for it? If you paid $100,000, your return is only 1% a year. You could do better in a high-yield savings account. But what if you could buy that same box for just $10,000? Now you're getting a 10% return every year. That's a fantastic deal. See? A stock is really just a piece of one of these cash-spitting boxes. And that simple idea is called the earnings yield. It's just the earnings of the company divided by the price you pay. You've probably heard of the PE ratio, right? Price to earnings. Well, earnings yield is just that flipped upside down. It's way more intuitive, I think. So if a stock has a PE of 20, you just do 1 divided by 20, and you get an earnings yield of 5%. That's your return on your investment right there. So what's a good number? Here's our simple rule of thumb. For one of these great, stable companies, you should be targeting an earnings yield of at least 5%. And that, of course, is the same thing as saying you shouldn't pay a PE ratio of more than 20. This one little rule can save you from making the #1 mistake in investing, which is just plain overpaying. Okay, we've found the company. We know the price. Now for the last piece of the puzzle. And honestly, this is the hardest part for most people. Section 5, when to be greedy. This is where we learn that your biggest enemy isn't the market, it's yourself. You've all heard this quote before, I'm sure. Be fearful when others are greedy, and be greedy when others are fearful. It's his most famous line for a reason, because the best time to buy these amazing companies, it isn't when the economy is booming and everyone's happy. No, the best deals show up when there's blood in the streets and it feels like the whole world is falling apart. And this is what it looks like in practice. Think back to 2007. The markets had a peak, everyone is greedy, thinking they're a genius. Then, boom, the financial crisis hits. Fear takes over. By March of 2009, it was pure panic, maximum fear. Every headline was about the end of the world. And that right there was the point of maximum opportunity. The people who had the guts to buy then, when everyone else was selling, well, they were very, very happy a few years later. So the trick isn't to predict a crash, it's to be ready for it. You need to have your shopping list of great companies prepared ahead of time. And when that panic eventually hits, you start looking for these signals. The PE ratio drops to 15 or even lower. The dividend yield starts creeping up past 4%. The stock price has been absolutely hammered, maybe down 40–50% from its high, and every news channel is screaming about doom and gloom. When you see all of that line up, that's your green light. That's when you get greedy. Look, none of us knows when the next big market downturn is going to happen, but we know for an absolute fact that it will happen. It's just part of the cycle. The difference is, now you have the playbook. You don't have to be scared. You can be prepared. You can act with a plan instead of reacting with panic. So the only real question is, when that opportunity comes knocking, will you be ready to open the door? All right, let's get right into it. What if I told you that you right there, have massive fundamental investing advantage over the single greatest investor who has ever lived? I know it sounds completely insane, but stick with me because by the end of this, you're going to see exactly why being a small, individual investor is a kind of superpower that even the Oracle of Omaha can't use anymore. First things first, let's give the man his due respect. We are talking about Warren Buffett, an investor who started out with just a little over $100 and spun that into a personal fortune of around $70 billion. There's no debate. He is the master, the legend. So that really brings us to the big question, doesn't it? How in the world can any normal person even think about having an edge against a financial titan like Warren Buffett? I mean, it just seems impossible. But the answer isn't about trying to beat him at his own game. It's about playing a game that he, because of his own success, is no longer even allowed to play. So here's how we're going to break this all down. First, we'll touch on the Buffett legend itself. Then we'll get into the really interesting part, these surprising limitations he has, which I like to call the billionaire's handcuffs. From there, we'll pinpoint your unfair advantage, uncover Buffett's simple one-sentence secret, and then wrap up with the two crucial mindsets that make this whole thing work. Okay, part one, the Buffett legend. And look, this really isn't just a story about getting rich. It's a story about time, about unbelievable patience, and a laser focus that started when he was just a kid. Just look at this timeline for a second. It's staggering. It all kicks off in 1942. An 11-year-old kid makes his very first investment with $114. Now, you fast forward over 70 years later, and that same discipline has compounded its way to nearly $70 billion. It's probably the greatest proof you'll ever see of the power of starting early and just staying in the game. But here's where the story takes a fascinating turn. That incredible success, the very thing that made him a legend, has now become his single biggest weakness. It's kind of ironic, really. He's become a victim of his own success, locked in what we can call the billionaire's handcuffs. Think about this for a second. Imagine having over $50 billion in cash that you have to find a home for. Sounds like the best problem in the world, right? But for Buffett, it's a huge headache. He can't put that money into small, up-and-coming companies. Why? Because the investment would be so tiny it wouldn't even make a dent in his portfolio. He's forced to go elephant hunting, as he calls it, looking only for massive, giant corporations to buy. And hey, this isn't just some theory. Let's look at a real-world example from back in 1999. Buffett knew his shares in Coca-Cola were way overvalued. He wanted to sell. Simple enough, right? Wrong. He couldn't. First off, he was on the board, which complicates things. But the real problem? His stake was so massive that if he even started to sell, the market would notice instantly. Everyone would panic, and the stock price would absolutely plummet before he could get his money out. He was completely trapped by his own size. And that brings us to the best part of this whole story, your unfair advantage. See, the very things that tie Buffett's hands are the exact same things that set you free. Being small, it turns out, is your superpower. Let's just put it side by side. Buffett has to invest billions at a time, so he's stuck in the playground with only the biggest mega-cap companies. He moves like a giant oil tanker, slow, careful, making waves wherever he goes. But you can invest $50 or $5,000. You can buy into a tiny startup or a huge blue chip. You're not an oil tanker, you're a speedboat. You can zip in and out of any investment, quickly, quietly, and nobody even knows you were there. And this is the most crucial point of all. The entire universe of small, nimble, fast-growing companies, the exact kind of businesses that built Buffett's fortune in his early days, are now completely off-limits to him. But for you, they are wide open. You can literally invest like the young Warren Buffett did. He can't. So you've got this amazing advantage. Now what? How do you actually use it? Well, it's not some complicated formula or trading algorithm. For the last 40 years, Buffett has been telling anyone who will listen what his core strategy is. It's been hiding in plain sight the entire time. And the beautiful thing about his approach is that it is not rocket science. We expect the secret to be some complex, genius-level equation. It's not. It's a simple philosophy that he's been teaching for decades. It's accessible to literally anyone who's willing to listen, and more importantly, willing to have the discipline to follow through. And there it is. That's the secret. Buy shares in a few high-quality, well-run businesses at a fair price, and then hold them forever. That's it. That's the whole game. It's so simple. It's powerful. Just let that sink in for a moment. Now, this is always the first question people ask. If it's really that simple, why isn't everybody rich? It's a fair question, and the answer is because the hard part isn't knowing what to do. The hard part is actually doing it. The challenge isn't intellectual, it's all psychological. And that right there leads us to the single most important mental shift you have to make. If you want to invest like Buffett, you first have to learn to think like him. And that all comes down to seeing yourself not as someone playing the stock market, but as a part owner of a real business. This is the absolute core of it. For Warren Buffett, a stock isn't just some blinking ticker symbol on a screen. It's not a lottery ticket. It is a genuine piece of ownership in a business. When you buy a share of a company, you become a part owner, and you are entitled to your slice of every dollar of profit that business makes from that day on. And this is so important to understand. Imagine you own a small piece of a great local pizza place. If they have a record year and the cash register is overflowing, you've done well as an owner. You don't panic and sell your stake just because someone on the street one day offers you a little less for it. Your ownership is tied to the business, not the daily mood swings of the market. The stock price can go haywire, but your share of the actual profits is real. Okay, let's bring it home with his most famous metaphor. It perfectly captures his entire philosophy. See, for him, investing isn't about finding these complicated, high-risk, high-reward moonshots. It's about finding the obvious wins. It's all about what he calls stepping over one-foot bars. Buffett understood this really deep truth about us humans. We just love to overcomplicate things. We think that for a solution to be really good, it has to be complex, maybe a little confusing. We build these incredibly difficult systems when a super simple answer is staring us right in the face. And his solution to that human tendency is just brilliantly simple. He says, I don't look to jump over 7-foot bars. I look around for 1-foot bars that I can step over. He's not trying to be an Olympic high jumper. He's just looking for the easy, obvious wins, the businesses that are so clearly good that investing in them isn't some huge leap of faith. It's just a simple step. So what's your roadmap to start doing this? It really boils down to 3 basic skills. Step 1, you have to learn how to spot what a truly high-quality business looks like. Step 2, you have to learn how to figure out what a fair price is to pay for it. And step 3, you have to develop the discipline to buy it at the right times. And notice, none of these are really technical skills. They're more like tests of your character and patience. And really, that's the ultimate takeaway here. The secret to great investing isn't about having a genius-level IQ. It's about being disciplined. It's about sticking to a simple, logical plan and just ignoring all the noise and panic from the market every day. The world is just full of 1-foot bars, amazing opportunities that are now too small for the Oracle of Omaha to even notice, let alone step over. So the only question left is, where are you going to find your first one? So what actually makes a business great? A truly great one. To figure that out, we're going to get inside the head of one of the world's best investors. And, well, we're going to do something that might feel a little backward. We're going to start by understanding what makes a business not so great. All right, let me just ask you something. Have you, even for a second, ever thought about the specific brand or the design of those little metal staples you feed into your stapler? I know, it sounds like a totally random place to start, but believe me, it is the absolute perfect one. Okay, here's what we're going to cover. First, we'll look at Warren Buffett's 2 simple business worlds. Then, we'll use that humble staple as our main case study. After that, we'll break down what a commodity business really is, look at which big industries are full of them, and finally, we'll learn how to flip our perspective to think like an owner. So, to kick things off, let's check out Warren Buffett's view of the business world. It's actually shockingly simple. For him, there's a really clear line in the sand. And that's it. That's the divide. In Buffett's mind, you've got the truly great businesses on one side, and then you have everything else on the other. His entire investment philosophy is built around pouring all your energy into that first group and just actively avoiding the second. Your time, your money, it's just too valuable to spend on anything less than fantastic. So the question is, how do we get really good at spotting those great businesses? Well, we're going to kind of flip this on its head. The best way to truly appreciate what makes a business special is to first get a really solid understanding of what makes one just fundamentally tough. And that brings us right back to that little piece of metal. The humble, overlooked paper staple is about to tell us a massive story about competition, about business, and about profit. I mean, really think about it for a second. Do you have a favorite can't-live-without-it brand of staples? Are you losing sleep at night just waiting for the release of Staples 2.0? Of course not, right? And that is the entire point. You know how it goes. When you run out of staples, what do? You hop online or go to the store, you see what's there, and you buy the box that works and costs the least amount of money. Your entire decision is based on pretty much one thing: price. And this right here, this brings us to a super important word: commodity. A staple is the perfect example of a commodity. It's a product that a ton of different companies can make. But as far as you, the customer, are concerned, they're all basically the same. There's no real difference. Okay, so let's get into the nitty-gritty. Let's dissect the anatomy of a commodity. What are the forces at work that make this such a ridiculously hard business to be in? Let's start with brand recognition, or, well, the lack of it. You've probably heard of Swingline, right? Maybe because of their staplers. But what about Advantis, or PaperPro, Max? These are all real companies making staples. The fact that we have no idea who they are, that proves the point entirely. So here's the bottom line. When nobody cares about your brand, the only weapon you have left to compete with is price. The whole game becomes a race to the bottom. Whoever can figure out how to make staples for the absolute lowest cost is the one who wins. And the math behind it is brutally simple. You've got your materials, zinc, steel, glue. You've got your labor, which you find in the cheapest places on Earth. And the winner is just the company that can mash those cheap inputs together to make the cheapest output. There's no secret sauce. So let's just recap what this little staple has taught us. A not-so-great business, number 1, makes a commodity. Number 2, it operates in a really crowded market. Number 3, it has basically zero brand recognition. And number 4, and this is the big one, because of all that, it has absolutely no power to set its own prices. The market tells you what your price is, and it's always pushing it lower. And here is the real kicker, the gut punch for the business owner. Let's say you have a brilliant idea and figure out how to make staples 5% cheaper. You don't get to keep that extra profit. No way. The competition is so fierce, it forces you to lower your price just to get sales. So that saving you created, it goes straight to the customer. It doesn't stick to your business. Now, you might be thinking, okay, I get it for staples, but that's a tiny, boring product. But here's the thing. This exact same dynamic plays out across huge, globe-spanning, incredibly important industries. This isn't just about what's in your desk drawer. Just take a look at this list. Airlines, they are constantly in a brutal price war. Car makers, steel producers, oil and gas companies, even the companies that make the most basic building blocks of our economy, like corn and wheat and textiles. For the most part, these are all incredibly tough, price-competitive businesses where it's just really, really hard to make a great profit year after year. And this right here is why a company like Apple is so fascinating, so brilliant. They don't want to play that game. They let other companies deal with the tough, low-margin, commodity-like business of actually building the parts and putting the phones together. Apple puts all its energy and money into the stuff that allows them to charge a premium price: the technology, the brand, the design, the marketing. They completely sidestep the price trap. And that brings us to what I think is the most critical part of this whole discussion: shifting your perspective so you can start to think like an owner. Now, I have to be really clear about something here. These are not bad businesses for society, not at all. We desperately need companies making steel and flying planes and growing food. They're the absolute foundation of our modern world. But, and this is a big but, being vital for the economy is not the same thing as being a great business to own. And that's the mental switch we have to flip. Right now, we stop thinking like customers or employees. We are putting on our owner's hat. As the saying goes, we're Scrooge McDuck or Warren Buffett. And what's our main concern? Profit. Because from that owner's point of view, the goal is dead simple. You want to own businesses that can make and, more importantly, keep the biggest profits possible for a really long time. You're looking for the companies that don't have to give away all their hard-earned wins to the customer. So if you take just one thing away from all of this, let it be this. While it might not be totally impossible, it is exceptionally, incredibly difficult to build real, lasting wealth by owning a business that's stuck in one of these price-competitive, commodity-style industries. The deck is just stacked against you from day one. So I'm going to leave you with a challenge. Using this new way of looking at things, just start observing the world around you. The gas station on the corner, the restaurants in your town, the stores at the mall. Now that you know what to look for, ask yourself, which of these businesses are playing a game that is just fundamentally, almost impossibly hard to win? I think you might be surprised by what you see. Welcome to The Explainer. You ever look at a company and just wonder, what makes it great? Not just good, but the kind of business that just seems to print money year after year, decade after decade? Well, today we're going to get into that very question, and we're going to use the wisdom of probably the best guide there is, the legendary investor, Warren Buffett. And it's a tough one, right? I mean, there are literally thousands of companies out there. They're all vying for your attention, all shouting about how they're the next big thing. So how in the world do you filter through all that noise and find the real diamonds? Well, luckily for us, we're going to follow the playbook of someone who has mastered that exact skill. And here it is. This is our starting point. And you know what's so amazing about this quote? It's how simple it is. It's not about some crazy complex algorithm or chasing the latest trend. Nope. It's all about clarity, consistency, and having the patience to think about the long, long run. So to really get a handle on this, we're going to break down his wisdom into 5 key areas. We'll start with simplicity and why brands matter. Then we'll get into what makes a business truly timeless and repeatable. Then we'll cover the incredible superpower of pricing and this idea of an economic moat. And we're going to wrap it all up with a simple checklist you can use yourself. Okay, let's jump right in with the very first part of Buffett's test. We're talking about the twin pillars of simplicity and having a strong brand. Now, these might sound a little obvious at first, but trust me, they are the absolute foundation for everything else we're going to talk about today. So the first rule is just profound common sense, really. If you can't sit down and explain to a friend in like a minute what a business actually does to make money, you probably shouldn't be investing in it. Complexity can hide a whole lot of problems. And you can see the difference couldn't be clearer. Coca-Cola sells drinks, Starbucks sells coffee. You get it instantly. But a company like Enron? Heck, even the experts couldn't figure out exactly how they made their money. And it turned out that was for a very good reason. Simplicity just cuts down your risk because you actually know what you own. Okay, next up. We're looking for a brand that isn't just known, but one that is basically set up shop inside the consumer's brain. It's about owning a valuable piece of mental real estate. You know, this is my absolute favorite way to think about a brand's strength. You know a brand is truly dominant when its identity is so powerful that even a little kid can point to it and know what it is. Just think for a second about what it takes to build that kind of recognition and how impossible that feeling is for a competitor to just copy. Right? Great brands are memorable. They create loyalty. You know the names Wrigley, Hershey's, and Colgate because they mean something consistent. But the company that made the stapler on your desk, it's probably a commodity, totally interchangeable, totally forgettable. And that means it has to compete on price and price alone. All right, let's move on to our second section. See, having a simple business with a strong brand is a fantastic start. But for it to be truly great, it needs an engine. And we're talking about a business model that is timeless, one that can keep churning out cash, not just this year, but for decades. This is all about durability. Is the company selling something that people just need or really, really want? You have to ask yourself this critical question. Are people still going to be buying this exact same thing in 10, 20, maybe even 50 years from now, long after all of today's hot trends are a distant memory? So here's the crucial point. It's all about where the profits go. Coca-Cola's main product has been basically the same for a century. That means the profits can flow to the owners. But a semiconductor company? It's on this relentless technological treadmill. It has to pour a ton of its profits right back into R&D just to stay in the game. Those profits never get to the investor. And the second part of this powerful engine is all about habit. We're not looking for those rare, big, one-off purchases. We want things that people buy out of routine, out of necessity, or as a small treat, over and over and over again. And this repeat business, this is the lifeblood. It creates a predictable, consistent, super reliable stream of money that you can pretty much set your watch to. A car company, for example, has to go out and find a brand new customer for every single car it sells. But a company like Colgate or Starbucks, they just have to wait for you to run out. Now we're getting to the absolute heart of it. This is the one thing that Buffett himself has said is the single most important decision when you're looking at a business. This is its superpower. This really is the ultimate test of a business's strength. It's what you get when you have that simple business with that powerful brand that people buy again and again. When you have all that, you earn the right to raise your prices, and your customers, they'll stick with you, often without even thinking twice about it. What's so amazing about this slide is just how blunt he is. There is zero ambiguity here. He's saying the ability to raise your prices without fear is the clearest sign you own a great business. And if you can't, well, then you've got a terrible one. It's really that black and white. And this is just a perfect illustration of the whole concept in action. So after he bought See's Candies, Buffett realized that people didn't just buy the chocolate. They loved the brand. It was a tradition, a part of birthdays and holidays. So when he raised the prices, people didn't complain. They happily paid a little bit more for a product that was tied to all these happy memories. For an owner, that is an absolute goldmine. So how do all these amazing things, simplicity, a strong brand, a repeatable business model, pricing power, how do they all combine to protect a great business from the competition? Well, Buffett has this really powerful metaphor for it. He calls it an economic moat. It's a great image, isn't it? Just like a big castle would have a wide moat filled with water to keep invaders out, a great business has this protective barrier around it that keeps competitors from storming the walls and trying to steal its profits. And this moat, it can come from a few different places. A strong brand like Coke's is a moat. It creates a trust and a habit that's almost impossible for a new company to break. A patent from the government is basically a monopoly for a while. Being the lowest cost producer like Walmart is a brutal, powerful moat because you can win any price war. And sometimes, you're just the only game in town. But the key here is that the advantage has to be durable. It's got to last for a long, long time. Okay, so we've covered all these ideas. Let's bring it all home. We can distill everything we've talked about into a simple, really powerful checklist that you can start using to spot these great businesses for yourself. And here it is, your 5-point filter. Is the business simple? Does it have a strong brand? Is the product timeless? Do people buy it repeatedly? And the big one, does it have pricing power? If you find yourself nodding yes to these 5 questions, chances are you are looking at a truly excellent company. And that's where we'll leave it. I want you to think about this question. Just look around at the products and services you use every single day. The coffee you drink, the phone in your pocket, the stuff you buy at the store without even a second thought. If you start applying this framework, you might just be shocked to find how many great businesses with these deep, wide moats are hiding right there in plain sight. When you look at legendary investors, you ever wonder how they just seem to know which companies are the real deal? Well, I'll tell you, it's not some kind of magic. They're just reading a story that's kind of hidden in plain sight, and that story is told in the language of business. So today, we're going to learn how to read that story. We're going to use a simple 5-point checklist to uncover the secrets hidden right inside a company's financial statements. So what really is the secret sauce here? What is it that separates a pretty good business from a truly great one? Let me tell you, it's not always the coolest new product or some flashy CEO. The real answer, the thing that gives a company a durable, lasting advantage, it's written in the numbers. It's a story of profits and debt and cash flow that, once you learn how to read it, well, it can totally change the way you see the business world forever. Okay, so here's our game plan. We're going to put 2 companies you definitely know, through a 5-point gauntlet. We'll look at their earnings, their profitability, their debt, and probably most importantly, how they reward their owners. And by the end of this, you're going to have a powerful little scorecard to help you spot the next great business. All right, let's meet our contenders. In this corner, we've got a global icon that's been quenching our thirst for over a century now? Coca-Cola. And in the other corner, a titan of industry that literally put the world on wheels. Ford Motor Company. Now, both of these are giants, right? Household names we all grew up with. But as we're about to see, when you look at their financial DNA, they could not be more different. Now, look, don't worry. You don't need to be some CPA or an accounting whiz for this. We're just going to be looking at the language of business, the financial statements. And the best part is you can find all this information for free really easily on sites like Morningstar, which is actually what we're using for our examples today. So let's get started. All right, here we go. Rule number 1. This is it. This is the first, and I'd argue the most important question you should ask about any company you're looking at. We're looking for one thing above all else here: stability. The kind of stability that lets you actually sleep at night. And here's the rule. A great business has earnings that look like a staircase, not a roller coaster. This isn't just luck, folks. This is the sign of what we call a powerful moat, a competitive advantage so strong that it protects the business from its rivals, and it allows it to grow predictably year after year after year. Just look at this. This is Coca-Cola's earnings per share. It is a beautiful, steady climb, from 65 cents all the way up to $2 over 16 years. That right there is what a deep, wide moat looks like in the numbers. It's just relentless, predictable growth. This is the financial signature of a company that is in complete control of its own destiny. And now, let's look at Ford. Wow, it is like night and day, isn't it? This isn't a staircase. This is a roller coaster with the lights off. You have years of huge profits, and then they're followed by years of just devastating losses. This is the financial signature of a company that's in a brutal, hyper-competitive industry. And think about it. It makes sense. Coke can always sell you a soda for a profit. Ford sometimes has to sell you a car for a loss. just to keep the factories running. Big difference. Okay, so Coke is 1 for 1, and Ford is, well, already in a bit of trouble. But what about profitability? I mean, it's one thing to make money, but how efficiently are you making it? Let's peel back another layer of this onion and find out. Our next tool is something called return on equity, or just ROE. The easiest way to think about this is like a company's GPA for making money. It answers a really simple question. For every single dollar the owners have invested in the business, how much profit does the company generate each year? It just tells us how good a company is at turning its own money into more money. So what's a good grade here? What are we looking for? Well, we're looking for an A-plus student, a company with a consistent ROE that's above 20%. Now, why 20%? Because, look, any business that can consistently generate more than 20 cents of profit for every dollar of its own capital, that is an incredibly efficient economic engine. And would you look at Coke's report card? They're not just passing, they are absolutely acing this test, year after year after year, consistently up there in the 30s. It's really remarkable. And yeah, the high number is great, but it's the consistency that just screams quality. This is what a really special business looks like. And then we have Ford. Oof. See that NMF? That's basically a failing grade. It stands for no meaningful figure, which is just a fancy way of saying the company lost so much money, the calculation doesn't even make sense. And even when it does make a profit, the numbers are all over the map. There is zero consistency here. But hold on a second. There's a little trick here, a sneaky way for companies to play the system. By taking on a whole lot of debt, they can actually reduce their shareholder equity, which can artificially juice up their ROE number, making them look way more profitable than they really are. It's kind of like a financial sleight of hand. So, how do we spot the fakers? Well, this brings us to rule number 3, and this is our little secret weapon. It's called return on total capital, or ROTC. This is our truth serum. It's a lot like ROE, but it includes all the company's long-term debt in the calculation. So it measures the return on all the money in the business, not just the owner's money. There's just nowhere to hide. And for this one, we're looking for a consistent return over 15%. And the results? Well, they speak for themselves. Coke just sails over that 15% bar with no problem, averaging over 22%. This proves its profitability is the real deal. But Ford? Oh man, it's not even close, averaging a measly 6.3%. Remember that brief period of high ROE we saw? Turns out it was just a mirage, created by a mountain of debt. ROTC tells the true story. Okay, so we've just seen how debt can be used to fool investors. But let's talk about debt head-on. You know, a little bit can be a useful tool, but too much can be an absolute death sentence, especially when the economy hits a rough patch. So the question is, how much is too much? How do you know if a company is playing with fire? Well, here's a fantastic, simple rule of thumb, and this one comes straight from Warren Buffett himself. A great company should be able to pay off all of its long-term debt with less than 4 years of its profits. It's just a simple, powerful, common-sense test of a company's financial strength. And the best part is this is something you can do yourself in like 2 minutes. It's super easy. You find the total long-term debt on the balance sheet, you figure out the average profit over the last few years, and you just divide the debt by the profit. It's that simple. And it tells you exactly how many years it would take for the company to be totally debt-free. And the results of this test, they are absolutely staggering. Coke, with its massive predictable profits, could pay off all its debt in about 3 years. No problem at all, totally within our safety zone. Now, look at Ford. It would take them 21 years. Let me say that again, 21 years. That is not just a red flag, my friends. That is a full-blown 5-alarm fire. That level of debt leaves absolutely zero room for error. And now for the best part, the reward, the ultimate goal of all of this. What does a truly great business, one that passes all of these tough tests, do with all that cash it's making? Well, it gives it back to you, the owner. I want you to really let this sink in. In just 3 years, after paying for every new factory, every single delivery truck, every single thing it needed to run and grow the business, Coke had over $24 billion in cash left over. So what did it do with it? It returned all of it to its shareholders through dividends and buying back stock. That right there is what a true cash machine looks like. You know, Charlie Munger, Buffett's longtime partner, he put it best. He said, "We want to own businesses that drown us in cash." And that's it. That's exactly what we're looking for. A business so profitable, so dominant, that it produces way more cash than it can possibly reinvest, and it sends that river of cash straight to us, the owners. So there you have it. We've put Coke and Ford through our 5-point gauntlets, and I think the results are pretty crystal clear. So now let's just put it all together into a simple scorecard that you can take with you and use for your own analysis. Here it is, your 5-point checklist for finding a great business. Number 1, smooth staircase-like earnings. Number 2, a high and consistent return on equity, over 20%. 3, a true measure of profitability, return on total capital, above 15%. 4, low debt, less than 4 years of profit. And number 5, it's an absolute cash machine that drowns you in cash. So Coke passes this test with flying colors, and Ford, well, not so much. This simple checklist doesn't just tell you about a company's past. It gives you a really powerful lens to see the true quality and the durability of a business. So the question I'll leave you with is this. What companies do you know that might be able to pass this 5-point test? Start digging. You might be really surprised by what you find. Thanks for joining me.
All right, so you've put in the hours, you've done all the research, and you've finally found it. What you think is a truly fantastic, high-quality business, and that's great. But you know, finding the company, that's only half the battle. Now comes the really tricky part.
This is the big one, right? The core dilemma every single investor has to wrestle with. What is the right price to pay for this great company? Because if you get this wrong, even the most wonderful business in the world can turn into a terrible investment. We've all seen it happen. So, how do we actually figure this out? How do we avoid that trap of overpaying?
Okay, to get our heads around this, let's start with a really simple thought experiment. We're going to strip away all the complicated stuff for a minute. Forget the stock tickers, the news headlines, all that noise, and just get back to the absolute basics of what it means to invest in something. So, I want you to picture this in your mind. It's a simple, unadorned black box. No logos, no fancy designs, nothing. But this isn't just any old box. It has a very, very special property. It's almost magical, and it's what makes it so incredibly valuable. Here's what it does. Every single year, like clockwork, it spits out $1,000 in cash. Bam! $1,000 right in your hand. It's perfectly reliable, perfectly consistent. So the big question is, how much would you actually pay to own this little money-making machine? Seriously, take a second and think about it. What's that $1,000 a year stream of cash really worth to you? All right, let's play this out with two different prices. What if you paid $100,000 for it? Well, that $1,000 it spits out gives you a 1% return on your money. Now, what if you only paid $10,000 for the exact same box? Suddenly, that same $1,000 is a 10% return. See what happened there? The box didn't change. The cash it generates is the same. The only thing that changed was the price you paid, and that completely transformed the quality of the investment. So, let's ask the question. Is a 1% yield a good deal? I mean, is it? On its own, that number doesn't really mean much. With any investment, you always have to ask, compared to what? You've always got other places to put your money, right? So, let's put it into perspective. And here's the reality check. Right now, you could stick your money in a government-insured savings account and get a 1% return with basically zero risk. So, would you really risk $100,000 on our mysterious box to get the exact same return? No way. It makes absolutely no sense. Now that 10% yield, on the other hand, well, that's a whole different ballgame, isn't it? That starts to look pretty compelling. And this is the whole point. The price you pay dictates your return. Okay, so this whole black box thing, it's not just a cute analogy. It's actually the key to understanding how to value a real business. Because a public company, it's really just a much more complicated and hopefully more dynamic version of our money-making box. Think about it. When you buy a share of stock, let's say Coca-Cola, you're buying a tiny piece of their black box. It's not magic, of course. Their black box is a massive global business that makes and sells drinks to billions of people. And what does that business spit out? Well, it spits out cash in the form of profits, or as we call them, earnings. Now, this idea of comparing the price you pay to the cash the company spits out, it might seem a bit academic. But I promise you, you already know the term for this. You've heard it a million times, even if you haven't connected it back to our black box. It's one of the most common metrics in all of finance. And there it is, the P/E ratio, price to earnings. All it is a simple fraction. It tells you how much the market, that's you, me, everybody else, is willing to pay for one single dollar of a company's earnings. A high PE just means we're all paying a lot for that dollar of earnings. A low PE means we're getting it on the cheap.
But here's a little trick, a mental model that I think is incredibly powerful. We always talk about the PE ratio, but what happens if you just flip it upside down? Something amazing happens. The whole concept becomes so much more intuitive.
You get the earnings yield, E over P. And what is that? Well, it's the yield from our black box. It tells you, in plain English, what percentage of your investment the company is earning for you right now. It takes that abstract P over E number and turns it into something you can actually compare to a savings account or a bond. It makes it real. So check this out. A stock with a PE of 20, well, that's an earnings yield of 5%. Okay, that's pretty reasonable. But what about one of those hot stocks with a sky-high PE of 50? You flip that over, and you're looking at an earnings yield of just 2%. All of a sudden, that exciting, high-flying company looks a little less exciting, doesn't it? It forces you to ask a really important question: why on earth would I accept a 2% return to start? And that is the million-dollar question. And there's really only one good answer. The reason you'd accept a low yield today is because you believe that yield is going to grow. You see, unlike our simple little box that spits out the same $1,000 every year, a real business has a secret weapon, an upgrade. And that upgrade is growth.
A truly great business is a master at this. It can take some of that cash it spits out, reinvest it back into itself, new factories, better products, you name it. And in the future, it spits out even more cash. It's like it has a compounding engine inside. So that 2% yield you start with, it might not stay at 2% for long. It could be much, much bigger down the road. Let's make this super concrete with a company we all know, Coca-Cola. So at the time of this analysis, Coke had an earnings yield of about 4.25%. Not bad, but let's assume it can grow its earnings by a pretty reasonable 5.5% a year. Well, you fast forward 10 years, and those earnings have grown a lot. And here's the magic part. Your yield, based on the price you paid 10 years ago, has now jumped from 4.25% to over 7.26%. That is the incredible power of compounding growth. But, and this is a huge but, you have to be so careful here. Paying way too much for that future growth, even for a fantastic company, can absolutely wreck your portfolio. It's a classic trap. People get so excited about the growth story that they completely forget to look at the price tag. And that is a very, very dangerous mistake. And there's no better cautionary tale than Microsoft during the dot-com bubble. Back in 1999, people were euphoric. They were paying a PE of almost 50 for Microsoft stock. That's a 2% earnings yield. Now get this. The business itself did fantastically over the next 10 years. Its earnings more than doubled, but the stock price? It went nowhere. A whole decade of nothing. Why? Because that insane PE of 50 collapsed down to a much more normal 13. The business did great, but the starting price was so high that it ate up all the returns. The lesson here is just so clear. Price matters. It matters enormously. I don't care how great the company is, it's not worth an infinite price. Think of the price you pay like an anchor. If you pay a low price, you've got the tailwind of growth pushing you forward. But if you pay too high a price, it's like a giant anchor dragging behind you, and you'll spend years just fighting to get back to even.
Okay, so after that cautionary tale, let's look at the flip side. What happens when you get it all right? When you find that great business, you see the growth path, and you manage to buy it at a reasonable price? Well, that's the holy grail. That's when the real magic happens. Just look at this number. It's absolutely mind-blowing. When Warren Buffett bought Coca-Cola back in the late 80s, he bought it at a great price when others were fearful. Today, the annual dividend he receives is more than 50% of his original investment. Let me say that again. Every single year, he gets over half of his initial money back, just in dividends. That's the power of getting the business, the growth, and the price right. So what's the path? You know, it's simple, but it's not always easy. You find a great business. You have the discipline to wait and buy it at a reasonable price, which means a good starting earnings yield. And then, the hardest part for most people, you just hold on. You let the company do its thing, growing its earnings, growing its dividends, and you let time do the heavy lifting for you. The results can be life-changing. So, the next time you're looking at a company, especially one that everyone's excited about with a high PE ratio, I want you to do one thing for me. Just flip it over in your head. Ask yourself, okay, what's my starting earnings yield here? And then, is the future growth I'm expecting really enough to make up for this low starting point? It's a simple mental shift, thinking in terms of yield instead of just price, but believe me, it can make all the difference in the world.
You know, it's the one question every single investor asks, whether you're a total pro or just getting your feet wet. When is the absolute best time to buy a stock? It feels impossible, right? Like you need a crystal ball. But what if the secret isn't some complex formula, but a simple, powerful lesson from one of the greatest to ever play the game? Today, we're diving into that. And right out of the gate, we get this gem from Warren Buffett. It's his entire philosophy, really, boiled down to one sentence. Sounds easy enough, doesn't it? But here's the thing. Understanding these words is easy. Actually having the guts to do it when the world is screaming at you to do the exact opposite, well, that's the hard part. That's where the real money is made.
So here's our game plan for today. We're going to start with that big question every investor has. Then we'll unpack Buffett's simple but powerful rule. From there, we'll look at a real-world crisis to see it in action, talk about 2 specific ways you can time it, and then wrap up with how you can get ready for the next time this opportunity comes around. All right, let's dive into Section 1, the investor's big question. We're all trying to unlock this secret of market timing. I mean, who isn't? But the reality is, very, very few people ever manage to get it right. So what makes it so darn difficult? And there it is, the million-dollar question. So when do you pull the trigger? Is it when a company posts fantastic earnings? Or maybe when the economy just feels like it can't be stopped? When every talking head on TV is yelling, buy, buy, buy? See, the trap is that all of those moments, when things feel the most certain, that's usually the worst time to buy. It's when prices are highest, and it lures us right into buying high and, inevitably, selling low, the exact opposite of what we're trying to do.
So, if buying when everything looks rosy is actually a trap, where do we find the real gold? Well, like Buffett said, it's not found in the sunshine. The real wisdom, the true opportunity, is found when things look bleak. Let's talk about the wisdom of bear markets.
You know, when I say bear market, what pops into your head? For most people, it's just pure panic. Red arrows on the screen, scary headlines, maybe the word crash. It's become a synonym for danger. But for the investor who's ready for it, it's something else entirely. It's the sound of a massive opportunity knocking at your door.
This right here, this is the mental flip you have to make. It's so important. Think of it this way. If your favorite store suddenly put everything on sale for 50% off, you wouldn't run away screaming. No, you'd grab the biggest shopping cart you could find. A bear market is exactly that. It's a fire sale on the world's greatest businesses.
Okay, so that all sounds great in theory, right? But does it actually hold up in the real world when things get, well, messy? Let's put it to the test. We're going to jump in a time machine and go back to one of the scariest financial moments of our lifetimes and see how this all played out.
The company? Coca-Cola. I mean, everybody knows Coke, one of the most solid blue-chip companies on the planet. And the setting? The 2008-2009 financial crisis. And folks, this was pure, raw fear. Banks were on the brink of collapse, the headlines were apocalyptic. It really felt like the whole system might just break down. In other words, it was the perfect environment for a prepared investor.
Let's get into numbers. First, Coke's price-to-earnings ratio, the PE, it dropped all the way to 12.38. The easiest way to think of PE is just as a price tag. It tells you how much you're paying for $1 of the company's profits. A lower number means a better deal. And for a fortress like Coca-Cola, seeing a PE under 15 is like finding a luxury car with a giant clearance sticker on it.
Now let's flip that PE ratio on its head, and we get the earnings yield. Back then, it was over 8%. This is, well, it's like the interest rate the business itself was earning for you on your investment. Just think about that for a second. An 8% return from the actual profits of Coca-Cola. That's not just good, that is a spectacular bargain.
And if that wasn't enough, check this out, the dividend yield. This is the cold, hard cash the company pays you just for owning their stock, and it hit almost 4.4%. So let's put it all together. At the absolute height of the financial panic, Coca-Cola was offering you an incredible deal on its stock and paying you a handsome 4.4% in cash just to hold on and wait for the recovery. You were literally getting paid to be brave.
And this chart, wow, it just puts it all in black and white, doesn't it? Look at the difference. In 2009, you had that low PE, that juicy 8% earnings yield, and that huge dividend. Look at it later. in a more normal market. The PE nearly doubled, meaning the stock became twice as expensive relative to its earnings, and both the earnings and dividend yields got cut in half. The conclusion is just undeniable. 2009 wasn't just a good time to buy. It was an objectively, mathematically incredible once-in-a-decade opportunity.
And here's the kicker, the most important part of this whole story. You didn't need to be an insider. You didn't need some secret algorithm or a hot tip. All of this information was public, available to anyone who wanted to look. The only thing standing between an investor and this amazing opportunity was their own fear. It took real courage, absolute nerves of steel, to step up and buy when everyone else was running for the exit.
Okay, so we've seen that these moments happen. They're real. But knowing that isn't enough, is it? How in the world do you actually spot them as they're happening? Well, that's what we're going to get into next. We're going to build your practical toolkit. And we're going to break this down into two really practical methods that you can use together. The first one is all about the company's actual value, and the second one is about using the market's own behavior as a signal. So method one is the valuation method. This is where you ignore all the noise, all the panic in the headlines, and you just look at the business itself. You're just asking, what price am I paying for this company's performance? And the source material gives us two fantastic rules of thumb for a great, stable company: a dividend yield of around 4% or more, or a PE ratio of 15 or less. When you see those numbers, it's a huge flag that the stock is probably on sale.
Now, the second approach is the market timing method. This one is interesting because you're actually using the market's fear as your buy signal. History shows us time and again that in a real panic, even the best companies in the world get thrown out with the bathwater. So a simple but really powerful rule is to get extremely interested when a great stock falls 40 to 50% from its recent high. A drop that big is often a sign of maximum pessimism, which, for us, is exactly what we're looking for.
And just in case you think 2009 was some kind of a fluke, look at this. This happens. It's a pattern. Coke dropped almost 60% in the early 2000s. It dropped over 40% in the financial crisis. As they say, history doesn't repeat itself, but it sure does rhyme. These huge sell-offs are not weird, once-in-a-lifetime events. They are reoccurring opportunities for the investor who's patient enough to wait for them.
Okay, we've covered the why and the how, but now we've got to talk about the most critical piece of this whole puzzle, your action plan. How do you get yourself ready for the next time this happens? Because trust me, it's not a question of if we'll have another bear market. It is only a question of when.
So think of this as your personal bear market checklist. This is what you pull out when things start to look scary. First, you check the emotional temperature. Is every news story about doom and gloom? Are your friends and neighbors talking about selling everything? That's your cue to pay attention. Then you confirm it with the hard data. Is your target stock down 40, 50%? Is the PE low? Is the dividend high? When that story of widespread fear lines up perfectly with the story of great value, that, my friends, is your green light.
And we'll come full circle back to Buffett here, because he just nails this idea. He doesn't see bad news as a threat. He sees it as his best friend. Bad news is the very thing that creates the sale. It's what gives you the chance to buy a piece of a phenomenal business, a slice of the future, at a discount. You really have to retrain your brain to see a scary headline and think, my best friend is here.
And this leads us to the final, and maybe the most important paradox of all. The real work doesn't start when the crisis hits. It starts now. To be able to be greedy when everyone else is scared, you first have to be fearful when everyone else is greedy. What does that mean? It means when the market is flying high, when everyone is euphoric, that's when you should be cautious. That's when you build up your cash. That's when you prepare your war chest so that you're ready to go shopping when the sale of a lifetime finally begins.
So we'll end on this thought. The source material couldn't be clearer. Another bear market, another fire sale on the world's best companies isn't a possibility, it's an absolute certainty. It is going to happen again. So the only question that truly matters is the one you need to ask yourself. When it gets here, will you be ready for it?
All right, so you've put in the work. You've done the reading, you've soaked up the theory, and you really get the principles. But let's be honest, there's a huge gap between knowing the path of a great investor and actually walking it. In this explainer, we're going to close that gap. We're talking about how you get started today. And really, this one sentence says it all, doesn't it? You can read a mountain of books, you can watch hours of videos, but absolutely nothing will teach you more than actually putting some skin in the game, even just a little bit. The theoretical part is over. The real learning, that starts the second you decide to act.
So let's dive right in. It's tempting to finish a book and think, okay, done. But with investing, it's the total opposite. What you've reached is the end of the beginning. You've passed the classroom part of the course. Now it's time to step into the lab where the real education actually begins. And seriously, you should feel good about that. That foundation of knowledge you've built, well, that's what separates you from a gambler. You're not just throwing darts at a board. You have a framework. You have a plan. You are, without a doubt, ready for what comes next. So what is it then? What's that final hurdle standing between all that amazing knowledge you've gathered and actually putting it to work? It's that little moment of hesitation, isn't it? That little voice in your head that says, maybe just one more chapter, or I'll just wait for the market to be perfect. That barrier, it's not a lack of knowledge, it's a lack of action.
And that brings us right here to the power of doing. You see, there's a world of difference between knowing something in your head and truly understanding it in your gut. That deeper kind of understanding, let's call it investor's wisdom. You just can't find that in a book. It's forged in the fire of the actual market.
Think about it like this. Knowledge is the map. It's essential. It shows you the terrain, it points out the dangers, it gives you a route. But wisdom, wisdom is the journey itself. It's the feeling of the ground under your feet. It's learning how to navigate when a road on the map is suddenly closed. It's experience.
And that journey, that's what builds your most valuable asset, real confidence. I'm not talking about ego or bravado. I'm talking about a quiet, solid belief in your process because you've seen it work with your own two eyes. Every single time you make a move, analyze the result, and learn something. Win or lose, you're building something that money just can't buy.
So yeah, it really all comes back to this simple truth. You just have to start. The good news? You don't have to bet the farm, not even close. There's a really smart, safe way to get started.
Okay, enough with the why. Let's get down to the how. We're going to break down your launch into a super simple, totally safe, 3-step plan. This isn't about diving headfirst into the deep end. It's about wading in carefully, getting comfortable with the water.
And here it is, your launch plan. Step 1, consult. It's just smart. Always run your ideas by your financial and tax advisors to make sure you're not missing anything. Step 2, and listen, this one is the absolute game changer. Start small. The goal here is not to get rich quick. The goal is to learn. And then step 3, grow slowly. You let your confidence and your capital grow together, hand in hand. It's a natural process.
Let's just double-click on that start small idea for a second, because it is so important. When you start small, everything changes. The financial risk is tiny, so the emotional pressure just melts away. You can stop obsessing over every little price move and actually focus on the process. And when you make a mistake, which you will, we all do, the tuition for that lesson is incredibly cheap. And from there, the logic of growing slowly just makes perfect sense, right? It makes sure your portfolio size never gets ahead of your confidence level. As your skills get better and your capital grows, you just methodically increase your positions. It's a system that naturally builds patience and discipline, and those are the habits of every truly great investor.
All right, as we start to wrap things up here, I just want to leave you with a bit of encouragement. You are right on the edge of putting some really powerful ideas into practice. And it's so important to remember that this isn't a journey you have to take all by yourself. Now, this is a direct promise from the author of the material we're covering, and it's a pretty powerful one. It shows that the goal isn't just to sell you something, but to actually help build a community of smart, confident investors who get real support when they need it.
And here's the proof in the pudding right here. That's not some generic support inbox that goes to a robot. It's a direct line. If you've got a question, if you hit a roadblock, there's a real person who's committed to helping you out. That is an absolutely incredible resource to have in your corner.
Because at the end of the day, this is what it's all about. It's not just about the numbers on a screen. It's about finding the whole process, the research, the discovery, owning pieces of great businesses to be genuinely rewarding. It's about building your wealth patiently, confidently, the Warren Buffett way.
So we end right where we began, with a call to action. You've got the map, you have a simple 3-step launch plan, the training wheels are on and ready to go. The only question left is the one you see right here. What's your first move going to be?